All right, guys, we know that the S&P 500 has just finished a pullback of roughly 3%. So it doesn't sound very dramatic, but it actually, I think, is the sharpest two-day drop that we've seen since the whole US tariff debacle back in early April. We saw way more than a 3% drop, but that is the largest two-day drop since then. Why does that matter, though? Well, it matters because after months of just rip into the moon, we've seen a little bit of a pullback, give us some breather room, reset some indicators, reset some sentiment, bring us down on the fear and greed index, and give us a base to hopefully continue higher. And I'm going to talk about why I think we're going to continue higher here in this video. We have seen a bunch of red flags about the potential for this kind of short-term correction for a couple weeks now, so it's not really unexpected. In early July, there was a lot of sentiment that was leaning towards the market becoming overextended. So you fast forward 1 month and conditions have shifted pretty meaningfully. Like we had the correction, we've come back down, we have some breather room, and now we're continuing our way back higher. So this pullback is not a red flag at all. Though these pullbacks that are happening on the way up should serve for you as a buying opportunity, because as we move towards the end of this year, I think there's going to be a lot of tailwinds coming on for risk assets that are just going to increase the prices even more. Now, why do I think, and a bunch of other very smart people, not that I'm one of those very smart people, I just listen to a lot of very smart people and try and form my own opinion, but why do I think that asset prices are going to have a lot of tailwinds and are going to continue to go to the upside for the remainder of this year and probably a little bit into next year at least? So if we look at the S&P 500 earnings per share, the EPS, we can see that corporate America is pretty resilient. It's been remarkably resilient, actually, with all the hubbub and all the narratives about what are tariffs going to do to corporate balance sheets and everything. They have been pretty resilient. Despite all those concerns, we've actually been increasing in earnings. They've only been accelerating. That's a extremely powerful backdrop for stocks. And if you ask any seasoned investor, that's only providing as a tailwind, meaning it's going to boost asset prices when corporate earnings are increasing. We also know, and I did a huge video that covered this the other day, that the dollar index has significantly dropped throughout 2025 in one of its largest downward moves over the past decade. And there is a lot more room to run for that dollar to fall. We are nowhere near the historical averages, and we have never seen really undervalued territory in our investing lifetime. So there's a good chance that that could be on the table as well. And we are trending in that direction. And why that matters is a weaker dollar typically also supports higher stock prices. Now, at the same time as those things, we also have interest rates that have been falling. We have the short-term rate, like the 2-year yield, that's been trending down since about 2023, which is important for two reasons. First, lower interest rates mean lower borrowing costs for companies and consumers. That means that people can spend their money more on things that they want to, which keeps the economy going. When they have lower borrowing costs, then that means they're going to spend more on other things. Second, lower rates also reduce the discount rate that investors use when they're valuing future earnings of stocks and companies. So to put all that in layman's terms, there's basically a formula that has a numerator and a denominator, and the denominator has that interest rate in it. So when you have a number in the top that is being divided by a number that is smaller on the denominator, the output is going to be bigger. So say a stock price is worth 10 divided by the interest rate. This is way oversimplification, but say interest rates are 5, 10 divided by 5, stock price is 2. Say interest rates go down to 2. 10 divided by 2 is 5. Stock price has gone up. That's going to increase the buying of a lot of companies and a lot of stocks. The bottom line there is stock prices go up when rates go down. Now, the trends don't stop there. Let's look at oil. Oil prices have also been trending lower in recent months, which is a huge win for the consumer and only leads to the same thing. They're going to spend more on other things, gives them more breathing room. It supports them living their life and spending on groceries and necessary things like consumer staples, but also discretionary spending on vacation spending and, oh, let's get the latest, greatest toy and food and all the things that keep the economy going, how much the consumer is spending. So when you put all of that together, weakening dollar, falling interest rates, cheap energy, more spending, you get loose financial conditions. That's what we call that, loose financial conditions. So historically, when we have loose financial conditions and when all of these forces align, it is incredibly rare for stock prices to go down. We've seen it time and time again. That setup has repeatedly fueled some of the strongest rallies all throughout history. So I'm not pretending to know the future. Past results don't guarantee future performance. And I think that making predictions with complete certainty is an absolute fool's game. But I'm just trying to interpret all this data that's coming in, look historically at what's happened, and then go forward with a plan of action. And then until that plan of action is proved wrong, until the conditions change or the price action doesn't support this narrative anymore, then you adjust your strategy. But we know that this narrative has been supported by higher price action time and time again in the past. So we have no reason to believe that it's not going to be that way right now. So right now, it seems like my channel is all about Bitcoin and gold, crypto and gold. I mean, I'm sorry to say, I just think that those are some of the best assets to be invested in right now if you're looking for some pretty exponential gains, especially with Bitcoin and how volatile that is, and cryptocurrency as a whole not seeing the completion of its 4-year cycle and alt season yet. There's still a lot of time and runway left there, but that window of opportunity to get in before prices start to go up dramatically is decreasing. We are nearing the tipping point, okay? We just had one of the weakest job reports with the non-farm payroll report that got revised, the whole hubbub about we were at 100 and something thousand jobs being added, and that was revised all the way down to like 20,000. That's a horrible jobs report, and that brings us closer to rate cuts, essentially. When the labor market is not able to effectively add jobs, the Fed doesn't see that as a good thing, and they want to cut rates in order to combat that. Now, we have seen inflation tick up a little bit, been pretty low, but it is ticking up a little bit right now. So that's an interesting narrative, because if we do see inflation increasing, that's an incentive for the Fed to not cut rates. And if we see the labor market going towards contraction and losing jobs or gaining less jobs, that is an incentive for them to cut rates. So if those two things conflict, it will be interesting. But as of right now, inflation is not so high to the point where if we do see a weakening labor market, we could still promote the idea of cutting rates in order to save the labor market. So when we cut rates, and because of all the things that I just said, we should see some significant boosts in asset prices. We should see some major tailwinds coming at the end of this year into the beginning of next year for however long this QE, quantitative easing cycle, is going to last. However, there's something else coming after that, and that is if the labor market goes into contraction and we start to enter recessionary territory with inflation, that's a recipe for disaster, and that is probably going to lead to a significant market sell-off. We kind of thought we were there with the tariff, with the whole tariff debacle, the tariff tantrum people call it, with the stock market correcting as much as it did over the period of time that it did. But the fact that we rebound as quickly as humanly possible, basically, that was not the correction that people are talking about that is going to reset asset prices and kind of wipe the slate clean before we can build another foundation and continue higher. So when you're looking at the jobs report numbers, you want to make sure that that job creation does not turn negative, because historically that is when everything starts to unravel. The last 3 times that we saw negative job growth, so we lost jobs, was 2020, 2008, and 2020 and 2001. And if you can remember anything about each of those 3 times, there was a big market crash. I think the range is somewhere between 30% and 60%. So I don't think that kind of sell-off is imminent. It's not here yet. Like I said, there's a lot of tailwinds that are coming up that I think that's still in the near-term future, but we still should see some increases before that comes. And we will see other signs and data that comes in that shows that buyer exhaustion is happening, and that the upwards track is now slowly plateauing, and we're reaching this tipping point of then coming back down. We'll see a lot of data coming in that supports that narrative as well. So I don't think we need to worry about that big crash yet. But this does highlight how vulnerable the US economy is right now, okay? If one major asset bubble just bursts, that could easily push the labor market into contraction, which would start the whole ball rolling, and it would knock over all the pins. That means the equities would be dragged with it, pretty much all asset prices would be dragged with it. So you need to be prepared for that. Again, I don't think that is coming just yet, but just know that that's on the horizon. Oh, and one more narrative that I forgot that I'm going to talk about real quickly before we end it. I'm not going to get too much into detail because I did make a whole video that you guys should go and watch about the revaluation of our gold supplies. This is a really interesting topic. The Fed is going to revalue all of our gold supplies, meaning that I think they were priced at like $42 per troy ounce. That's what our current valuation of gold is at right now. The current market price of gold is like $3,400. So that's going to create like $8 to $11 trillion out of thin air. And then what they're going to do, watch my video on this breakdown. It's pretty interesting. In the Fed notes and in the Crypto Strategic Reserve Act bill, which is currently going through Congress right now and has a good chance of passing, they're going to use some of those funds from the revaluation of gold to just steamroll it into a strategic Bitcoin reserve. So the government is going to be buying up to a million Bitcoin, however many dollars that is, I don't know, in order to fund their strategic preserve. So that's just yet another tailwind for crypto and Bitcoin. I know I've been talking about that a lot recently, but that's a huge tailwind. So if you guys are interested in that, go check out that video on my channel. If you guys like this type of content and you like easily digestible content about complex economic topics like this, hit that subscribe button, and I'll see you guys in the next video. Peace.